We're here because free speech is under attack. We're here because people are being convinced that socialism works. We're here because people are being judged guilty until proven innocent. We are fighting back with facts. This is not a safe zone, so buckle up, Buttercup. This is the raw, naked truth.
Welcome to the Raw Naked Truth. I'm your host, Eric Lopkin, and with me for this Wallet Watch segment is John Rocco. John, how are you this week?
Good. How are you, Eric?
Doing well. So, the markets rebounded slightly, and we've seen oil go up and back down a little bit, and then up and back down a little bit. What do people need to be paying attention to?
Well, I think we've seen, obviously, there's been a ton of money printed, as we talked about in the past, over the past year or so, and everyone was expecting some kind of a correction. And I think as this thing started to materialize, we knew interest rates were going to go up this year, and we got the correction pretty much that everybody wanted. In a manner of speaking, you always want to see prices adjust to reality, but then it got worse, and we ended up getting this attack on the Ukraine by Russia, which was totally unexpected. Even though we expected it, nobody really expected it to really happen, and it did. And all that did was put more pressure on prices, and it put more pressure on oil, and it's going to put more pressure on inflation, and it's going to put more pressure on the Fed to raise rates even more aggressively than what they had hoped. So we end up in a situation now where there's no question that interest rates are going to probably continue to go up, and we're going to continue to see prices of oil, et cetera, remain high, if not go higher. So there's going to be a lot more pressure on the consumer. So all of that is weighing. Those are the things really to keep an eye on. As far as the rebound that we saw over the past week or so, it's very difficult to tell if that is just a knee-jerk reaction to lower prices and a lot of people buying on the dip, coming in, trying to get some bargain prices, because so many stocks have been hammered 20, 30, 40, 50% or more in the past couple of months, that there are some great bargains out there. However, it's hard to tell if this is a what you may call a bear market rally, and this is the beginning of a longer term slog where the markets, have a lot to digest over the next 6 months. It's going to be a tough to continue to climb into record territory with all that's going on. So it's difficult to say if this is obviously if the war ends tomorrow, that's going to be a big benefit for the market. But this bear market, or this pressure on the market, is not just a function of the war. It's really a function of inflation and interest rates, higher interest rates.
Right. Now, okay, you mentioned the bear market, but it's been quite a while since we've had a bear market. Aren't we sort of overdue for one?
Could be, yeah. I guess the last real bear market you could say that we've had was back in 2009, 2008, in that period of time where we had the mortgage meltdown, and that led to the first phase of printing a lot of money to get us out of that mess. The last pullback was when the pandemic hit, and that I guess you can't call that a bear market. It was a disaster, but it was quickly averted by the Fed printing a ton of money, just a ton of money, and and it's really all that excess cash that was created over the past year or two that it has created the inflation that we have. But we also have other problems. We have shortages that have nothing to do with excess money. It's simply mechanical reasons why we simply can't get the product to the shelves. So, so raising interest rates may not solve the problem. Raising interest rates might make things worse because it's going to cost, it's going to do is it's going to cost companies more money to borrow. It's going to put more pressure on their earnings, and it's not necessarily going to slow down the economy and make prices come down, because the function of prices going up are really a function. A lot of it has to do with shortages, and now we have the problem of higher oil prices, and oil ships everything, and there's a fundamental price increase for all products when price of oil goes up.
Right. Now, aren't we in sort of a chaotic state with all of this? I mean, the Fed is trying to slow down the economy and inflation, but we already have a number of economists saying we could be heading into a recession later this year. So
Right, and that's correct. Yes, and that's the difficult part, the extremely difficult role the Fed has. If they raise interest rates too quickly, too much, they're going to drive us into a recession. And they all know that. So that the trick is that they're walking a tightrope where they've got to very slowly, gradually increase rates and do it in a way that doesn't drive us into a recession. And the second thing that they're doing is they were purchasing bonds on the market every single month, and this is, in simple terms, what we call printing money, because the Treasury is issuing bonds and the Federal Reserve is buying the bonds and putting them in their own account. So they have $9 trillion of this debt that the Federal Reserve owns, and they need to start to get rid of that. So not only are they going to raise interest rates, but they're going to stop purchasing bonds on the open market. And by purchasing those bonds, they were keeping rates low, because if they didn't purchase the bonds in order for the Treasury to sell those bonds, they would have had to have been asking higher rates. So in order to entice people to buy a bond, you got to get a higher rate. But if you got a Federal Reserve that's buying them, then you don't need to raise the rates.
Yeah.
So
now, as the rates go up, I mean, what does the average consumer need to be paying attention to? Obviously, if interest rates go up, credit card rates are going to go up, mortgage rates are going to go up. What else should somebody be paying attention to if they're on, say, a variable mortgage or they have a variable interest rate credit card?
Yeah, well, those rates will go up. And for me and for the market side of it, what you're going to also start to see are risk-free CDs at banks pay higher interest rates. And you're going to see fixed interest bonds maybe offered by the government that are extremely secure, paying higher interest rates. And those higher interest rates compete with stocks. So if you can, and 5% is a jump, but if you can go out tomorrow and lock into a 5% 6-month CD, you may say, I think I'll sell some of my stocks and I'll just drop it into a CD and just pick up the 5% for now. And that drives the market down. So that's kind of, my side of it. Obviously on the consumer side, yes, their credit card rates are going to go up. Their loans are going to go up. Their price of buying a car is going to go up, and that's going to slow down the economy. And like we just said, it's that if they do that too much, if they go a quarter of a point is no big deal. But if these rates continue to climb, then it's going to slow down purchasing by consumers, which is reducing demand for everything.
Right. And, it's all connected.
It's all connected.
Right. And that's the raw naked truth. Thanks a lot for being with us, John. You can catch every episode of The Raw Naked Truth at xvadio.com/podcasts, the Apple Podcast app, Google Podcasts, Spotify, iHeartRadio, Stitcher, Amazon Music, Audible, and wherever you find podcasts. We'll see you next time.